In this video, we're going to switch gears just a little bit. We're going to start talking a little bit about some more terminology, some more structure with respect to options, and then we'll come back and explore a little bit more about profit and price movement. So there are what are referred to obviously as option markets. There are really two kinds of options. There are conventional options, and then there are listed options. Conventional options are typically used more by institutional investors, and our discussion here is primarily about what the individual investor would be interested in purchasing. Now, how they act is very similar. There's not much difference between the two. But the listed options, they were created in 1973 by the Chicago Board of Exchange. They're traded on several different exchanges. Essentially, these exchanges provide a convenient market. So the trading can be much more liquid, much quicker, much more efficient. Obviously, they're helping to create this secondary market for the purchase and resale, the trading activity. But these listed options also have what's are standardized. So it really doesn't matter what option you look at. The strike prices move in the same direction. There's the same dates. What this does is, quite frankly, I think it creates a tremendous amount of convenience to investor that you don't have to analyze the option, the actual structure of each option, since they are standardized, and then you can just concentrate on the investment, the underlying security. That's where you want to use your analytical tools on that. They're saying about 4.3 billion listed options contracts are traded a year. We've talked about the strike price, right? This is this fixed contract price to act. Conventional options can have any strike price. It could be any dollar value you can think of, as long as it's agreed upon by the two parties. But as I mentioned just the previous slide, listed options have standardized prices and price increments. So if you have a stock that's trading at $100, the strike prices are obviously around that $100 mark. But if you also have a stock that's trading for $50, the available stock options are obviously down around that $50 range. So they are very structured as to how they are created. And all stock options have expiration dates. All right, this is when it becomes, essentially it expires. And there are two kinds of options, really. What we refer to as an American option allows an investor to exercise their right anytime you want, up until obviously the expiration date, because beyond the expiration date it no longer exists. Now there are things called European options, and European options only permit investors to exercise on the expiration date. Right? So all the exchange listed in the United States are all American options. Now it turns out that people would rarely ever exercise prior to the expiration date. Because if you're placing and making a bet, if you exercise prior to the date, you're kind of leaving some money on the table, because there is a value associated with time. And we'll talk about this a little bit in another video. But you don't want to leave any money on the table. So you probably wouldn't exercise unless you really needed and wanted that security. So again, all of the options that you can think of that we would be talking about all have standardized expiration dates, and they go in cycles. So each issue is going to be assigned to a particular cycle. So January, April, July, and October, right? Those are all potential expiration dates, months, and you can trade in the two nearest months. So the current plus the next two. So you can trade, if we think about this first cycle, you could, for a particular option, if you bought it in January, you could buy it in January or April or July. Those are the months that it exists. And really, if you think about it, it's because they really only have a 90-day kind of expiration, if you will, or life cycle. So they only really exist for 90 days. So if you think January, February, March, if you bought it in January, at the end of March, it's going to expire. Likewise, if you buy it in April, right? Those next 3 months, those are the only months that you could purchase them in. So again, they always expire on the third Friday. I don't know that the expiration information here is all that relevant or important, but we just need to know that they are very short term and they have very structured expiration windows, if you will. Obviously, there's a commission when you buy and sell, reduces the profit that can be earned. Many online sources to get option quotes. And frequently you'll hear something referred to as an option chain. Again, this is a listing of all options on an underlying asset for a given expiration period. So here is an example of an option pricing mechanism, if you will. So here's the option. And if you look, here's the dates. These are calls, right? These are all calls. And the things that they have circled here or highlighted, if you will. So the last price, premium price, was $8.40, right? There was a 20-cent change. Here's the bid ask. There were 233 contracts traded. The open interest refers to how many contracts are available. So in this case, there are 3,142 call contracts. I believe this is Disney. For Disney, I'm sorry, no, it's Facebook, sorry. And at an $80 strike price. So this is that. So if you go down here, the $85 strike price, there are 66,167 options available. Now if you go down the right here, if you look to the far right, these are puts. So here are the premiums, the last price for the premiums. So you can buy a put with an $87.50 strike price, and you'd pay $3.85 for that. And there are 2,178 contracts. So if you go down here, who is betting that the price that they're going to buy a put, they're buying a put, and the strike price is $95, right? There's only 99 contracts out there. In fact, on this day, there were no contracts sold on this particular day. So again, this is what the quoting system looks like online. So again, the value of an option depends on several things, right? It depends on time to expiration. Again, you are placing a bet, and since we have an expiration date, how much time is left has an influence on the value of that debt. It's based on stock volatility, right? If a stock price never changes, you couldn't have an option on it, or you'd never want to buy an option on it, because if the price doesn't change, the option can never be exercised. Interest rates in the economy are going to have an impact, and certainly the price of the underlying stock is going to be important. So the price of underlying stock is the most significant of the things. What we really talk about is this thing called the profit potential, because we're going to be talking about value and profits here. If you buy a call, the profit potential is unlimited, because since you're betting on the stock price going up, there's an infinite range, obviously, for the price. Now, in reality, you know that the stock price of even Apple, you know that it's not infinite, right? It's possible, but it's not. It's not likely in the next 90 days that Apple stock will go to $5,000, right? It's just not likely that that would happen. There's very low probability of that. So even though the profit potential is unlimited, in reality it is structured just by common sense, as it won't. It's not an unlimited probability that you can get that. But if you buy a put profit is limited, because you're betting the stock price can go down, and of course the stock price cannot go below zero. So whatever the downside is for making profit as far as price goes down, if it goes to zero, then obviously you can't make any more money because the price can't go to a negative value. So if we look at how values change and how profit changes, right? So here we have this call option. Here's the profit is zero here. If you buy a call, you obviously have to buy the premium, right? The premium here costs $500 to buy this contract, and the exercise price here is $50. So when the when the underlying stock goes to $50, up until that point, you as a buyer, your loss is $500. But as the stock goes up in value beyond the exercise price, for every dollar that it goes up, since there's 100 contracts, for every dollar the stock price goes up, your profit increases by $100. So at $51, your loss would be negative $400. At $52, it would be negative $300. And when you get to $55, that would be a break-even point. So you would have, at that point, zero profit. The value of what you have would increase. You have an increase in value, but it's offset by the premium cost. So likewise, we have the exact same process to evaluate puts. Again, when you buy a put, you have you pay the premium, right? Negative $500, and then as the price goes down, since that's what you're betting, every dollar goes down again. You have an increase in value to a break-even point. Now, if you look, here's where we talked about unlimited profit. Since the stock price can go up an infinite amount, right? There's an unlimited amount of profit possible here. With a put, since the stock price can only go to zero, the most you could possibly earn is the strike price here, or the this potential zero value of the option. So let's talk a little bit about these value things, the things we've been talking about. Intrinsic value is the value that's created between the strike price and the stock's or the asset's market price. It can only be one of two things. It can either be positive or it can be zero. It cannot be negative. It can't have negative value. So the value of a call is the stock price minus the strike price. So if it's a $50 stock or a $55 stock and it has a $50 strike, the value of each option is $5. And of course, every contract is $100, so that'd be $500. If the strike if the stock price was $45 and the strike price was 50, since this is negative, it would be equal to 0. So it has value or 0. The exact same thing is true with a put, except here you see since we're betting the price going in the opposite direction, the formula variables are switched here. So we have this call option has a strike price of $50. The underlying stock price is 75. Then we would say that its intrinsic value is $25. 75 minus 50, that's our 25 times 100, $2,500. If the price was $25, again, since this is negative, the value is 0. And likewise, we have the same analysis if you look at a put, where it's either value or 0. So when you look at an option, we have some ways that we can kind of classify options. And quite frankly, this is important because the pricing and the ultimate premium that you pay is influenced by this category that they come in. And their sensitivity, if you will. So changes in the variables obviously affect value, and depending on which category in here, there is varying amounts of sensitivity and movement in the premium. So an in the money option is one that has value, right? The call option, the strike price is less than the market price. The put's the exact opposite. So when an option is in the money, its intrinsic value is obviously greater than 0. Out of the money means it has an intrinsic value, but it's 0. The intrinsic value is 0. So this means that we haven't gotten to a point where somebody would want to exercise the option. And of course, at the money means the strike price equals the market price. So again, we have this terminology that really we want to think of it as being kind of descriptive. But with respect to options, again, we'll talk about some pricing in another video. How prices change is influenced by where they are in this range of out of the money to in the money pricing, if you will. See you in the next video.